Hello, and welcome to this week's economic update. My name is Lindy, and it's been a few weeks. We took a few weeks off there. We had some technical difficulties, so we're back on track now. So, we're going to go ahead and get started with what the Fed had to say this past week. So, the Fed had a meeting last week, and here's some of the comments and notes that came from that. The Fed left the rates unchanged at a current rate of 5.25 to 5.5, which you may have seen in the media. The next Fed meeting is October 31st through November 1st. Wage growth has shown some signs of easing, but the Fed feels unemployment will decrease from 4.1 to 3.8%. And then expectations are the Fed fund rate will remain elevated through 2024, so through next year, making the 2% Fed target difficult. 12 of the 19 Fed members believe we should have one more rate hike this year. That led to lots of comments. One of the comments I found interesting from one of the economists over at Wells was navigating a soft landing for the economy may prove difficult because higher interest rates increase borrowing costs for both companies and consumers, slowing economic activity. So that was all the brouhaha after the Fed meeting last week. Talking about supply not keeping up with demand still. So from a new housing starts, permits were up 7% from last month and are now only down 3% from last year. Starts were down 11% from last month starts and down 15% year over year. So permits are I went and applied for the permit to build the new house. Starting is I started digging and building the new house. Of that 11%, they were down from last month, though 7% of that 11 were multifamily. So very few apartments are being started. Completions, meaning the house is finished and now in the market to sell. So completions of single family were down 7% from last month, on pace for 1.4 million. But remember, household formations are now close to 2 million. I see different things. It says 1.5, it says 2 million. So I'm going to say between 1.5 and 2 million, but we are still way more households than we have houses. So still have that supply gap. Moving on to existing homes. So National Association of Realtors released their existing homes for July. It is down 0.7% from last month to 4.04 million annualized, down 15.3% year over year. Inventory decreased slightly by 1%. Still, we have 3.3 months supply of home. Normal is 4.6. Still about days on market, 20 days. Still about 72% of homes were sold in less than 30 days, meaning priced right, it's selling. And still, investors remain about 16% of the total buyers. So we don't have much change from last month to this month. Pretty much the same story of supply and demand, right? Our herd on the streets for the week, the MBA forecasts existing and new home sales to gradually increase in 2024 and 2025. Nothing drastic or a big upswing, but gradual. National Association of Realtors recent survey said 39% of potential home buyers stated they are waiting for rates to come down as the reason they are not buying a home now. Zonda reports remodeling activity is projected to decline beginning in fourth quarter of this year. This is due to an increase in unemployment and continued weakness with existing home sales. Existing home sales by region, I just want you to know I'm from the Southeast, and so we won again. So the Northeast is at 12%, the West is at 19%, the Midwest is at 24%, and the South is at 45%. A lot of new construction going on in the South. So existing home sales by region. There you have it. And then last but not least, our weekly conventional mortgage rates. Again, remember, these are owner occupants. So you can see that we've been inching up. Last week, we were at 7.31. This week, we are at 7.41. In reality, if you were to go out and get a conventional owner occupant loan right now, you're probably closer to 7.5, 7.75. DSCR rates are starting to inch up a little bit. We really haven't made drastic moves, but what I'm noticing is that it's costing more in points to get that 7.5 or 8% interest rate than it was a few weeks ago. So following suit, they will start to inch up as well. Mortgage rates moved to their highest levels in over 20 years as the Treasury yields increased late last week. The 30-year fixed mortgage rate increased to 7.41%, the highest rate since December of 2000. And that was from the chief economist at MBA. And then last but not least, if there's anything I can help you with on your investor financing needs, please don't hesitate to contact me. Otherwise, have a great week. Thank you.